All right, welcome back to another edition of Intermediate Accounting 2. We're going to move on with Chapter 11. And in this chapter, we're going to be talking about depreciation, impairments, and depletion. So a lot of you will probably find this information is kind of a refresher from Accounting 2300 or Principles of Accounting. We're going to go into some more depth here, so hopefully you can stick with me throughout this. First, let's talk about depreciation in general. So depreciation is just a method of cost allocation. Depreciation occurs when, through passage of time or through use of a particular asset, like a truck, for instance, we are incurring an expense. Recall that we pay for a truck, say a year ago or several years ago. We're continuing to use that truck, but as time goes by and as we use that fixed asset, we begin to incur the expense. So the expenditure happened a while ago, and now we're just recording the expense, which is just another way of saying we're allocating cost. So depreciation is the accounting process of allocating the cost of tangible assets to expense in a systematic and rational manner to those periods expected to benefit from the use of the asset. So as we use the truck, we will incur the expense because using the truck generally means we're generating some form of revenue. Types of expense, and this is just for clarification, when I'm talking about depreciation, I'm talking about the wear and tear or the use of fixed assets or tangible assets. Intangible assets like patents or some type of legal protection, those things are amortized. Natural resources such as an oil reserve, those types of assets are depleted. So as we go through each one of these learning objectives, you'll see me use these terms over and over again, but I'll make sure that I'm using the word depreciation, amortization, and depletion very specifically. So there are three major questions we have to ask ourselves when we have fixed assets. First, we're going to want to ask ourselves what the depreciable base is, depreciable base to be used. And that's another way of saying how much will we expense in total over the asset's useful life. In other words, if we spend $100,000 for a piece of equipment, will we expense all of the $100,000, or potentially will there be some residual or salvage value at the end, meaning that maybe we only expense $90,000 of the overall $100,000? The second question we're going to ask ourselves is, what is the asset's useful life? In other words, over how many years will we use the asset? Now, years is one way of marking the consumption of an asset. We can also say, instead of years, we can also say miles, or say number of cups of coffee from a barista machine, right? There are different ways of measuring life. Generally speaking, most companies, they focus on time periods as a way of measuring an asset's useful life. Finally, what method of cost apportionment is best for this asset, which is a fancy phrase for basically saying which depreciation method will we use. So let's talk about each one of these questions in more detail here. Factors involved in depreciation. So the first thing we need to ask ourselves is about the depreciable base. What is the depreciable base for an asset? In other words, how much will we expense in total over the asset's useful life? So if we have, say, the original cost of a piece of equipment is $10,000, and at the end of its useful life, we expect to sell it on Craigslist for, say, $1,000, then the depreciable base, in this case, the depreciable base is $9,000. Now, a couple points I want to bring up here about depreciable base. And depreciable base has nothing to do with valuation. Has nothing to do valuation. So when I say valuation, I mean net book value or net market value. It really has nothing to do with how we value the asset. It really has to do with how we're consuming the asset. And in a lot of ways, we're saying, hey, depreciable base is an idea about how much value we're deriving from this piece of equipment. Also, another thing to keep in mind is the depreciable base may not simply be the cost of the asset. In other words, yes, it's possible that we could have, say, we could have a zero salvage value, in which case we would say the depreciable base is the full 10,000. But that may be a bit aggressive in terms of expensing or costing away the asset. Usually there is some type of value that is available within an asset even after it's been consumed throughout its entire life. So if a car has, say, 300,000 miles on it, there's going to be somebody who's willing to pay maybe $100, $500 for it. So we may not just simply say, well, depreciable base has got to be the cost. No, it's not. There's usually some type of salvage value that we have to take into consideration. So down below here, let's make a little note about depreciable base, that the $9,000 is total amount to be expensed over the asset's useful life. It's not going to happen all in 1 year. It's not going to happen right away. It may be 3 years, 5 years, 40 years. Who knows? But we'll spread that sucker out over those years. So the next question is, over how many years do we spread this expense? Factors involved in depreciation, estimation of service lives. Or another way of saying it is useful life. Useful life and service life, kind of the same thing. How long is this thing going to be in service? So over how many years are we going to spread the depreciable base? Think about it like spreading over a piece of toast. Maybe the toast, the bread is really big. Maybe it's really tiny. Okay, the size of the bread determines the overall life over which we're going to spread the depreciable base. The number of years is usually what we're going to use to determine the service life. And service, you have to keep in mind, there's some people tend to confuse service life from what's also known as physical life. Okay, physical life and service life are different. We don't want to confuse those, but oftentimes people do. Service life. Service life is similar to how many years you work until you retire, whereas physical life is essentially how old you are when you die. You're gone. The thing doesn't work anymore. We're going to bury it, not leave it on that road abandoned, right? That's physical life. The thing just won't turn on anymore, okay? Service life is the thing's still working, but, we're going to upgrade it to something else. So let's talk about service life again. Service life. Companies will retire assets for primarily two reasons. Physical factors, some sort type of casualty or expiration, poof, it's gone, it's stolen, it burned in the factory, fire, or whatever it was. Or, for example, say a vehicle is totaled in a car accident. Okay, we're going to go ahead and just retire that asset and say it's done. Okay, another reason why we potentially retire an asset is because it's inadequate. It's obsolete. Obsolescence is another big one. There are newer machines out there that are more efficient and probably cheaper to operate because they suck less electricity. There is Hide the Pain Herald. I'm retired. Yeah, smiley face. So we know the depreciable base, we know the service life, meaning the useful life. So what do we have to worry about now? The next thing we're going to talk about, the third thing, is cost apportionment, which again is just another way of saying which depreciation method we're going to use. So we're required to use a method that is both systematic and rational. It has to make sense. It has to be something that can be done on a regular basis. Doesn't require a lot of kind of guessing games, right? So there are there are three methods I want you to focus on. The first one being an activity method, which is going to be the units of production, or otherwise known as UOP, units of production. So mileage would be a big one, mileage. The other one that is by far is most common out there is straight line depreciation. And the reason why it's used so much is because it's simple, it's easy to do. Analysts like it, it's easy to back out those expenses to calculate EBITDA. So straight line method is by far the method that's most used. There are some times when it's more appropriate to use, say, a decreasing charge method or an accelerated method of depreciation. Sum of years digits is one of them. I don't want you to worry about that one. We're going to talk about the double declining balance. The double declining balance method. And there are other special depreciation methods. We're going to just go ahead and ignore that as well. So let's talk about the first method of cost apportionment, the units of production. Or UOP. Yeah, you know me. One thing as something is being produced, say we have a bunch of UPS trucks, right? And they're out delivering packages. Well, the more mileage we put on the trucks generally means we're delivering more packages. Delivering more packages means more revenue. However, something to keep in mind that depreciation under UOP is not necessarily associated with sales revenue. Okay? We can find a correlation between mileage and number of packages and amount of revenue derived, but there are some trucks that have to drive a long distance maybe to just deliver one package. Whereas if there are several stops along the way, yes, there are probably going to be more revenue for each mile that's ticked on. So you cannot, though, assume that there is an association between sales revenue and the units of production. It may be there, but it is very rare. It's very, not rate, rare. Rare to see a correlation. It's also very rare to see the depreciation be constant. And that's simply because production varies, therefore, because production varies, depreciation varies. Simple as that. So you cannot assume there's an association with sales revenue, and you cannot expect that the depreciation is going to be constant. So some analysts don't really like companies that use units of production, even though it's a more accurate way of matching depreciation expense with revenues derived. So let's take a look at an example here. Stanley Coal Mines, they have a crane, costs $500,000, estimated salvage 50, estimated useful life 5 years, productive life 30 hours. So how much depreciation does Stanley recognize if it uses a crane for, let's say, 4,000 hours? 4,000 hours. How do we go about doing this? What we're going to do is take the 500,000 and subtract off the estimated salvage value. So in this case, we're going to calculate a depreciable base of $450,000. And what we're going to do is divide that by, in this case, the total, this is total productive life, 30,000 hours. And when we do that, we calculate an overall depreciation charge per depreciation rate per hour. And that is calculated at $15 per hour. Cool. So what do we do when we calculate that? We multiply that by the actual hours that we use the machine. So in this case, if I run the machine for 4,000 hours, how much depreciation has been incurred from using this machine? Another way of looking at this is saying how much wear and tear has occurred in the machine. In this case, we can say $60,000 of depreciation. And that's it. That's how you do the units of production method. Now let's look at the one that is most commonly used, the straight line depreciation method. So we're just straight line method. Sometimes I abbreviate this SL or straight line method. So if you see me use abbreviations like that, just be aware that I'm referring to straight line method. In this case, we need to figure out how much depreciation Stanley recognizes each year if it uses the straight line method. And in this case, we still want to calculate a depreciable base of $450,000. That's the depreciable base. And what we want to do now is divide it by not the productive life in hours, but productive life in years. So divide it by 5 years. And when we do that, what do we get? We should see depreciation expense per year of $90,000. Now, the only thing left to do with that is ask ourselves what percentage of the year the asset was actually used. So if we bought the machine, say in June, say we bought the machine on June 30th, and we run it all the way to December 31st, we can say, well, it's going to be 90,000 times 6 over 12 months. So in that case, we would only depreciate $45,000. So straight line is pretty straightforward, no pun intended, a little bit of pun intended there. Straight line is pretty simple to do, but the points that students typically miss on an exam usually involve this step where they forget to calculate the percentage of the year that it was outstanding. So don't let that be you. So now let's move on to the one method that really causes a lot of frustration for students. A lot of points tend to be missed about this one, so let's pay close attention as we go through this method. This is the double declining balance method. Okay. This particular depreciation method does not deduct the salvage value in computing the depreciable base. We do not worry about the salvage value to come up with a depreciable base. We do use the salvage value in our calculations. I'll show you how it's done. But a depreciable base, we don't worry about that in this particular depreciation methodology. This method utilizes a depreciation rate percentage that is double or 2 times that of the straight line method. I'm talking about how to deal with that in a second here, but the idea behind this is we're going to depreciate this at a faster rate than simply straight line, but it's not going to be constant. It's not just going to simply be double whatever the straight line depreciation was. It's going to be somewhat of an exponential type of depreciation. So down below, here's what we need to focus on, okay? We're not going to worry about the productive life in hours. And the reason why is because we want to figure out what is depreciation using the double declining balance method, in which case it's somewhat akin to or related to the straight line method. Similar. We need to understand the straight line method in order to do this particular methodology. So the only thing we really need here is the cost of the crane, and that's going to be our starting point. And the estimated salvage value is going to be our ending point. The estimated useful life helps us figure out a depreciation rate under the straight line method. So think about our useful life like this. If our useful life is 5 years, okay, 1, 2, 3, 4, 5, right? Then each year, how much of the useful life is being consumed each year? So every year, one of the 5 years is being consumed. 1/5 of the life is being used up. 1/5 of the life equals 20% of the life. 1 divided by 5 is 20%. So every year that goes by, we have used up, under a straight line rate, 20% of the life. Well, that is nice, but we are using a double declining balance rate. So we're going to multiply that by 2 to get us 40%. That's the rate we're going to use in our calculation. So let's go over to the schedule. Now, the best way to learn and remember how to do this is by practicing this. So please take the time to practice filling out this schedule. The double declining balance method starts with, up in the top left-hand corner, $500,000. And it ends with, at the bottom right, $50,000. Okay? We're going to depreciate roughly $450,000, but we're going to do so not in a static or constant way. We're going to depreciate it very fast initially and then very slow later on, kind of like how a car depreciates in value. The depreciation rate that we're going to use is 40%. So you can go ahead and fill that sucker in. It's twice the straight line rate. Now, once you get that going, now the rest is pretty much just automatic. You're just going to go line by line and fill this out. 500,000 times 40% equals $200,000. And that is the depreciation expense for that first year. If accumulated depreciation starts at 0, and then we include into that account $200,000, then the ending balance in accumulated depreciation is $200,000, which means if we subtract $200,000 from the cost, our net book value is going to be $300,000 at the end of the first year. Again, the cost is $500,000. We depreciated away $200,000 of it, so now the net book value is $300,000. What do we do with that? Guess what? We use it this is the start of the next year. We start year 2 with a net book value of $300,000. We multiply it by 40%, which results in the next year's depreciation of $120,000. And when you add that to the existing $200,000 balance, then the overall balance in accumulated depreciation is $320,000. Now, that is the new accumulated depreciation. So let's ignore that guy. 500,000 less the 320 in accumulated depreciation means I have a net book value of 180,000. Wow! After 2 years, we ate over half of the cost, the value of the asset. This thing is depreciating very, very quickly. Take the 180, bring it back over here, multiply it by 40%. That gets us 72,000. Not so much expense this year. And that makes sense. Notice how, overall, the depreciation each year keeps going down. But it doesn't go down in just a linear way. The depreciation kind of looks like this. It starts high, and then it kind of gets very sort of what they call asymptotic, sort of depreciation. Year 1, 2, 3, 4, 5. That's how the depreciation looks over time. We use a ton of its value very early on. Towards the end, we're not consuming much value. Okay, maybe the thing isn't as fast or as efficient as it used to be. Okay, so now that we have $72,000 extra in depreciation, we want to add that to whatever the existing accumulated depreciation balance is. And that brings our total accumulated depreciation up to $392,000. Wow. 3 years have gone by and almost 4/5 of its value has been consumed. So what I want to do now is compare 392, subtract 392 away from the 500,000. And when I do that, I have an ending net book value of $108,000. Take that, start back over the beginning. 108,000 times 40% equals 43,200 depreciation expense for the 4th year. Add that to my existing accumulated depreciation balance, and now my accumulated depreciation is $435,200. I'm going to compare that now, subtract this away from the 500,000 caused. And that's going to result in a net book value of 64,800. We're almost done. Now, here's a shortcut. You don't necessarily need to bring the 64,800 all the way over here, because you know that the total amount that can be depreciated is the difference between the 64,800 and the 50,000 salvage value. And that difference we can go ahead and stick right there. 14,800 is the maximum amount that we can actually depreciate in that last year. Let me say that again. If we have a beginning book value of 64,800, and we know that the ending book value has to be 50,000, then the most we can actually depreciate between these two numbers, this versus this, gets us 14,800. Is that correct? Well, if you add 14,800 to the 435,200, guess what that totals up to? $450,000, which happens to be our depreciable base in the previous two methods. So 450 subtracted from the 500,000 gets me $50,000 salvage value. So at the end of the 5th year, I'll turn around and hopefully I'll sell it for $50,000 because that's currently what's shown on my books as the book value at the end of that year. So those are the 3 methods I want you to focus on: units of production, the straight line method, and the double declining balance method. Hopefully you can probably agree with me that the double declining balance method requires a bit more work. Trust that when it comes to an exam question, I'm not going to go into much depth in this. If you can calculate the first couple years worth of depreciation under the double declining balance, it should be fine. What I want to do next is move on to another example where we're going to look at all the 3 methods in one fell swoop. So in this situation, company purchased a new machine for assembly on August 1st, 2017. This is a key date to focus on, right? So all of August, let's do it this way, all of August, September, October, November, and December, assuming that we have a December 31st year end, you can tell right off the bat, 1, 2, 3, 4, 5/12 will be depreciated in the first year. The last year will be January all the way through July. That would be 7/12 of depreciation in the last year. You can kind of do these analyses as you're going through, but that's what analysis is. What does this number mean? Why is it important? How do I use that stuff? Whenever I see a date, I always start to draw a timeline. I recommend that you do the same thing. The cost of the machine was $150,000. The company estimated the machine would have a salvage value of $24,000 at the end of its service life. Its life is estimated at 5 years, or number of working hours, 21,000. So part of your analysis, when you're doing analysis, is break out these numbers in a way that makes sense to you. We get a $150,000 cost. There's a $24,000 salvage value. 5 years useful life, or 21,000 hours. Okay. What we want to do with that is calculate depreciation under units of production, the straight line method, and the double declining balance method. And when we do that, it's UOP. Yup. So, sorry. I have fun when I do this. What can I say? So, let's go back to the analysis here. If we have to do a units of production or straight line method, we have to calculate as part of a first step the depreciable base, which in this case would be $126,000. That's a depreciable base. I'm just writing this in on my notes so I can, because potentially I'll have to use it later. Another thing to be aware of, if the useful life is 5 years, then essentially that means under the straight line method, the rate of depreciation would be 20%, or 1/5. That's the straight line rate. Okay. And so we're going to use this information when we go through parts A, B, and C of this problem. So let's look at units of production. So assume, this is part A, activity method, units of production. Assume 800 hours were used in 2017. So I know that if I take the 126,000, that's my depreciable base, and I divide it by the number of production hours, total production hours, I'm going to get a rate of $6 per production hour. If I produce something for 800, if I consume the machine for 800 hours, simply multiply that by 800 hours. And what do you get? 4,800 must be the depreciation expense for that particular year. So down below, you'll probably see these kinds of things. Corporations have their own different schedules, so I don't want you to think when I show you a schedule, oh, that's the way everybody uses it. Okay. In general, the schedules I show you, these are the type of schedules you'll generally see when you go out there on an audit or you do some financial analysis for a company. Company for year 2017, hours given, usually you'll see the input, 800 hours. You see the rate, from up above, $6 per hour. And in this case, after this is usually fixed. Rarely does this change. This is usually what's inputted every single year. The $6 per hour, that might change down the road. Say we're about 2 years prior to the end of its useful life, we may revise the total number of hours that the machine can actually run. But generally speaking, once we come up with a rate per hour, we don't change it. The annual expense in this case is $4,800. Put this in black. $4,800 from up above. Okay. Now, the question comes down to this. Do we need to worry about a partial year? Not in the case of units of production. Units of production, the number of hours equates. This is actually proportionate. This is already proportionate to the year. So we can say that, hey, you know what? 800 hours probably approximates 5/12 of the year's worth of productivity. So we don't need to worry about this. Just put a little not applicable right there in that column. In which case we can just sort of carry this sucker over, the 4,800, carry that sucker over and say that's our current year expense. 4,800 then becomes our accumulated depreciation at the end of the year. Down below, the journal entry for 2017 would be a debit to depreciation expense on our income statement for 4,800, and our accumulated depreciation would be credited. Credit accumulated depreciation. That's a contra asset, 4,800. Boom, let's move on. So key thing to realize that under units of production, we don't worry about percentage of the year. We don't have to. It's already kind of baked into the 800 hours in this case. Let's move on down below into the straight line method. Straight line method is pretty straightforward. In this case, we know the depreciable base is $126,000 depreciable base. And we're not going to use hours this time. We're going to divide it by number of years. 5 years, useful life. And that gets us $25,200 depreciation expense per year. Only thing we have to worry about now is partial years. So, annual expense down below, we can just stick that sucker in there. This is going to be fixed throughout the year, just like with the units of production. So every year we expect every year, 25,200, 25,200, etc., 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 25,200, right? That's expected. We can do forecasting of cash flows and income based on that information. The only thing we have to worry about here is partial years. So for the first year, we ran it for 5/12 of the year, 5 months. Thereafter, it was 12/12, 12 over 12, etc., etc. The last year, we would have only run it 7/12, the first half of the year. We multiply those across. The current year's expense for the first year is going to be $10,500. Then for the next 4-ish years, 1, 2, 4 years, 25,200, 25,200. Can you see why analysts love straight line depreciation? Oh my gosh, it's so easy to back out and calculate EBITDA, which is earnings before interest, taxes, and depreciation and amortization, by the way. I probably didn't say that before. Last year will be 14,700. Okay? Accumulated depreciation builds and builds and builds. 10,500 the first year. Next year brings it up to 35,700. Brings it up to 60,986. You get the idea. accumulated depreciation. Again, why do we use this account? Because this is all theoretical. It's not like the asset's disappearing. We'll just keep track of this depreciation in a separate account. So total accumulated depreciation should be $126,000 at the end of its useful life, which, guess what, also happens to equal the total depreciation over the years, $126,200. Look at that. So nice, so clean, it works. Now down below, the journal entry we're going to record just for 2017. Pay attention to dates. Please, please do this. Please be careful. Don't just jump into the journal entry without asking yourself, what's the timeline? Depreciation expense on the income statement is $10,500. And we credit accumulated depreciation. Kevin. The contra asset account for $10,500. And that's how we do the straight line method. Last but not least, our favorite, yours and mine, the double declining balance method. All right, so again, figure out a start, figure out an end, okay? Calculate a double declining rate from the straight line. So start. The starting point was the cost. Start with cost. That was 150. Finish with salvage. That one is $24,000. And then the straight line rate, or should say our depreciation rate. Our depreciation rate is 2 times the straight line rate. In this case, it would be 40%, which is 20% times 2. These are the key inputs. So plug those into a schedule down below. Beginning 150. Ending all the way over here. I should have put in a grid. I think I took out my grids. 24. 1, 2, 3. And then our rate per year, 40, 40, 40, 40, 40. Once you get this inputted, you're on your way. So long as you practice just doing this over and over and over again, it's very, very hard to make a mistake. That's why we have schedules, okay? So let's start from left to right, top to bottom, okay? First thing we're going to do is multiply the beginning net book value, which is just $150,000, that's the cost, times 40%. We calculate $60,000 in this case, but be careful if it's a partial year. In this case, the first year is 5/12 of the year. Multiply that across the first depreciation amount is $25,000, which means accumulated depreciation goes from 0 to 25,000. Compare the beginning net book value with accumulated depreciation at the end of the year. What is the net book value at the end of the year? $125,000. And what do we do with that? Bring it into the next row all the way over here. $125,000. Now, if you just practice that over and over again, you should be fine on the exam. Just go through the methodology. 125 times 40% is $50,000. What portion of the year was it outstanding? Well, for the full amount, 12/12. In fact, let's go through and just fill out these suckers, shall we? Last one will be, we'll just call it plug figure. Don't put 7/12, just put plug. It's going to plug in the difference down there. Plug don't worry about 7/12. When we get down to the bottom, you'll see that we can't just multiply the 10th, can't just use this 10th, the bottom number here, whatever we calculate. It has to be the difference between the 24,000 and whatever is up here as our net book value at the beginning of that year. Let's just keep going forward. All right. 125 times 40%, 50, times 12/12 is $50,000. Add that to accumulated depreciation. That gets us a new accumulated depreciation, $75,000, which means if I compare that 75,000 with my cost basis, 150, that means my net book value at the end is $75,000. Bring that over to the beginning, $75,000 times 40% is, I believe, $30,000. Times 1, 12 over 12, equals 30,000. Add that to the beginning, accumulated depreciation. 105 is my ending balance at the end of the third year. And as I've done always, compare that 105 with the cost basis, 150, means my net book value is now $45,000. I'm telling you, if you just keep practicing this, you should be fine. 45,000 times 40% equals 18,000. And Lucas, if you're watching, hopefully you're checking my math as I go. I rely on you, buddy. 18,000 times 1 is 18,000. I think that one's right. 18,000 times 1 is 18,000. 18,000 plus 105 is $123,000. That's my new accumulated depreciation. And, as always, compare that against the cost basis. Ending net book value at the end of the fourth year is $27,000. If we want to, we can sort of ignore the rest of this stuff. We can just ignore this. And the reason why is because we know that the most we can depreciate here, 27,000, write that a little bit cleaner, 27,000 minus the 24,000, the most we can depreciate here is $3,000. That's why it's a plug figure. That's got to be the most. When you add that with beginning accumulated depreciation, you get $126,000. Guess what? That's our depreciable base. How about that? Nice when the calculations work out. It's nice when Kevin is behaving too. Boom. That's how we know we've done it right, that we've gotten all the numbers correct. Okay? So down below, what's the journal entry for 2017? Again, be careful of dates. Debit, depreciation expense on the income statement for $25,000. Credit, accumulated depreciation, the contra asset account for $25,000. And that is Learning Objective 1. Next up, we'll be talking about Learning Objective 3 in another video.